In this week's update, the bond market does not believe the Fed and inflation. There are highly conflicting signals, and it's pretty much a week to ignore. Short term, a lot more uncertainty. Longer term, quality and growth will prevail. My name's Garry Davis, and as always, this is general advice. And please remember to like and subscribe to the video. What an incredible couple of weeks that we've had since the Fed shifted their language and therefore their policy stance, and the markets really don't know where they're at, and there are very conflicting signals that are coming out of not only the equities market but also the bond market as well. So this is a time of in the very short term of significant uncertainty, that's for sure, but let me do my best to try and unravel it for you and give you where the probabilities are and where the balance of weight of evidence is. Now, at the heart of our financial system is interest rates. That's the core of how everything is priced, and to a large degree central banks over the last 10 years they've really messed it up, so that a lot of the old relationships that used to apply just don't apply anymore. And if you look at the current situation, we've got the US 10-year bond yield at, it's about 1.4 actually, but let's round it off and say 1.5%. We've got inflation at 6% plus, and who knows how much higher it may go. And so under normal circumstances, you would see rates would have been getting raised by the central banks years ago. We wouldn't be having this conversation under normal circumstances. So they're only just talking about raising rates now, and not until probably at least April of next year. So that's the Fed position. So they're going to start winding down the bond purchases, which has been keeping bond prices high and yields down. They're going to start winding that down as of now, and it'll be complete by March. The Fed has said they won't raise interest rates until that process is complete. So that gives us a bit of a timeline on their intentions. The second question then is the market, particularly the bond market, is normally well ahead of the curve, and they're already pricing in what they expect the Fed to do. And that you would have expected is that bonds would have been sold, because you don't want to own bonds when you're coming off really low rates and inflation is moving up. It's the worst possible thing you could do would be to continue to hold bonds or to buy bonds. So bonds would be sold, that pushes the yield up, and just over time brings everything back into line. So it raises the question, why is the bond market not selling off? And that is the real conflicting issue, the real surprise about what's happened in the last couple of weeks. Little surprised to see equities sold aggressively, because some of them were pretty stretched in valuation. But the bond market is the real head scratcher. So should equities still be high? Should the market still be trading at the level that it is? And depends on what yardstick you're looking at. If you're looking at the S&P, then we know that that's an agglomeration of the defensive and the aggressive sectors. So one tends to cancel the other out. So the fact that the S&P hasn't fallen hardly at all doesn't really tell us a great deal, because there's been a lot of movement at an individual sector and stock level. But if we look at it just in general, should equities be trading with the sort of buoyant sentiment that they have at the moment? And the answer, to a degree, this is not the whole answer by any means, but to a degree, it's there is no alternative really in terms of reward for risk. It's the equities market, and has been for quite some time. So that is part of the reason. And with interest rates really low, there's no reason why equities cannot continue to trade in the way that they have over recent years. But the question is, where are interest rates going? And that's what the market is trying to price in. I would encourage everyone, as I've said on regular occasions, to stop thinking about the market as a single entity. I get questions from people about what's the S&P going to do? Well, it doesn't really matter because you're not trading the S&P unless you've just got a balanced portfolio. So it doesn't really matter what the overall market is going to do. It's a matter of what are the stocks that you own going to do, and we're seeing enormous divergences there between different sectors. So my strong advice would be to target high probability areas of robust growth that fit into the mega trends, things that are pretty much unstoppable and are going to provide tailwinds for those stocks, and do your valuations on that. And don't worry about the valuations of the market. There's a lot of commentary out there about the Cape-Shiller index is high and the Buffett indicator is high and all these sort of numbers. It's all irrelevant. The only numbers that matter are what are the valuations of the stocks that you own. And all the rest is just contemplation. Now, the market reality is that it's trying to price in its perception of the future, not the facts of the future, because we don't know them yet. We don't know how they're going to pan out. So it's trying to price in A, perception, and B, the future. So it's always subject to getting it wrong. It's not pricing in today's facts. So if you look at the market and you see things that are seemingly illogical, then that's why, because it's not priced on what we have today. And that really gets back to this essence of what the bond market is saying compared to what the stock market is saying. The stock market is readjusting for a higher interest rate environment, and that's exactly what you would expect. But the bond market, the fact that it hasn't sold off and yields haven't risen sharply, is telling you that the bond market does not believe that the Fed is going to be forced to follow through with their interest rate policy. So they're saying that we don't believe inflation is going to be the issue that everyone seems to be acknowledging now, including the Fed. And there's one thing I've learned over the last 30 years, it's the bond market is the smartest guys in the room, generally. They're correct far more often than the equities market are. So if I have to place some sort of bias to my thinking, then I'm going to go more heavily with what the bond market is telling me. And the bond market is telling me that they just don't believe what is unfolding. So don't apply logic to what you can see, because it's going to lead you down the wrong path. You've got to follow the charts and look at a whole spread of different weight of evidence. Don't just look at the equities market. And what's far more important as traders and investors is consistency. If you're someone that needs to be right and you don't want to make a move unless you feel you can be right, or you stick with a move because you demand to be right, then you're in a lot of trouble. The far more important thing is to just get a good, robust, consistent process and just do that consistently. And most of the time, you'll be on the right side of the ledger. Sometimes you'll be on the wrong side of the ledger, but that's okay because you can't be correct all the time. But it's the consistent application of an approach to the market that's suitable for you that is going to win out hands down every time. So all we have is weight of evidence. All we have is probabilities. Just go where the money is, follow the charts, and that's about as complicated as you need to make it. All right, let's look at American stocks. The S&P ended up falling 2% for the week. Wednesday, when the Fed came out and basically made their policy statements, which wasn't too far away from consensus. So consensus was for stimulus to be wound back at a certain rate and for interest rates to be ramped up at a certain rate. And what the Fed said was a little bit different, but not terribly much. And in the last 90 minutes, there was a furious rally across all parts of the market, but particularly large caps. And I strongly suspect, in light of what happened after that this was just a short covering rally. That a lot of institutions had positioned themselves for the Fed to come out with a more negative announcement. When they didn't, there was short covering, and the prices went up really quite savagely. That wasn't evident at the end of Wednesday, but by Thursday it certainly was, because we got a right royal smashing in the market, pretty much across the board, large caps, small caps. And it's also likely that that was options expiry related. So options expired on Friday. There's no question that there's a level of market manipulation happens to reduce the number of in-the-money calls or in-the-money put options by pushing the prices or encouraging prices to move either up or down, depending on the stock. And I would like to bet a considerable amount of money that that's part of what we saw on Thursday. But then rolling to Friday, and we got an amazing surge in small caps. And again, I think the only explanation for me is that this was very much a contrived session. We had a lot of small caps that had been beaten down all year. There would have been massive numbers of in-the-money put options, and it was a significant advantage for market makers to encourage those stocks, if you like, to rebound strongly. And we saw some spectacular rebounds in some of the stocks that had been weakest all year. So when you see stocks that had been dragging the chain all year suddenly on options expiry day, put in probably their strongest performance of the year, you've got to be sceptical. So that's why I think the action that we saw last week in the US stock market was very contrived. It was very short-term dynamics driven, and therefore I don't think it means much. I don't think it points to much for the future. So I would kind of put it out of your mind. There might be some options expiry related activity in the first few days of next week, but once we get past Tuesday or Wednesday, I think the market will start to trade back on normality again. It will know what the Fed is about. The bond market is still betting against the Fed, so we'll have to see how that one plays out. But my money's on the bond market, quite frankly, and there's some obvious conclusions that come from that. And one is that, the growth stocks, particularly the big cap growth stocks, are probably not in the trouble that the market is currently betting that they are. Now, the US dollar was higher to 96.57. The 10-year yield, however, went down. The logic would have screamed that it should have gone up, 1.6, 1.7. Didn't happen. And the VIX got down to about 17 or 18. Did kick up a little bit because of all of the sharp selling. But nevertheless, 20.6 is not too bad. So let's look at some of the charts. We'll start with the important spread charts first. This is consumer discretionary versus consumer staples. And you can see that the market moved hugely defensive a couple of weeks ago, and particularly last week. And very, very sharp move down in that ratio, indicating the move to conservatism. Now, we did get a little bit of a tick up on Friday night, but look, as I said, the whole of last week, from my perspective, is contrived. It really should just be ignored, and we'll look in a few weeks' time and see how things look. This is small cap growth versus small cap value. Not a lot of change there. So small caps either being bought or sold across value and growth, defensive, aggressive, in roughly in balance. If we look at the large caps, a bit more selling in the large caps, as you can see, and that certainly occurred on Thursday, which was this big move down here. So a very sharp move from the large cap technology stocks, large cap industrial stocks. We saw the money go into utilities, went into real estate. It went into some of the healthcare majors like Pfizer. So a very significant move. But again, that also just sort of reversed itself a little bit on Friday. So very mixed signals. Okay, that's all I wanted to cover there. So let's now look at the S&P, just for the record. So you can see we had a sharp move down on Tuesday. Very positive Wednesday with that huge late rally. gapped up on Thursday, but then the market wasn't having anything of it and sold off. And then, of course, the large caps encountered more selling on Friday. But if we look at the Russell, you can see very positive Wednesday, beaten up Thursday, but really quite positive and far more positive than the S&P was. And look at the volumes. So again, to me, this is not a natural market. This is a manipulated market. If we look at mid caps, not quite as dramatic. So sitting somewhere in the middle between small caps and large caps, but definitely not hit as hard on Friday night as you would have expected. Now, if we look at currencies, we've really just been consolidating in this area between 96 and 97 for the last few weeks and getting up towards the upper end of that band. And the Australian dollar down the last two sessions, really reflecting the fact that it was more of a risk-off sort of sentiment in the market, and the Australian dollar will never perform when there's that sort of sentiment around. So 70.70 was where we finished. Our index was down, pardon me, 0.7 for the week. Materials were up, and healthcare was the big loser, with CSL raising a lot of capital for a big acquisition. So again, that is not really a trend change. That's just stock specific, and you can probably ignore that. So let's just have a quick look at some of those particular trends. If we look at the small caps in Australia, you can see some significant selling on Wednesday, but did manage to recover, and some really high volumes on Friday. Materials were the best performer last week, so you can see the rebound in the iron ore price has kept that sector boiling. There's the overall ASX 200, so it's really just going sideways. Healthcare was the big loser, so the big reduction in the price of CSL. Banks didn't do much, pretty flat across the week, and energy was down. So that's the Australian market. Have a quick look at Bitcoin. We had a peak over the 64,000 resistance, but that was weeks ago, and it's been all downhill since then. Again, Bitcoin reflecting the risk-off attitude. Gold, in this environment, you would think great opportunity to really shine, and it's still not able to do it. And whilst we did have a nice move on Thursday when the market got sold off, and we did move quite nicely to a high of 1815 on Friday, it couldn't hold it and finished down on its lows underneath the 1800 level. So if we look at it on a weekly, it's just stuck is the best word that I can use for gold. And silver is not showing any buoyancy either. Now, if we look at GDXJ, which is my preferred ETF to look at, there's nothing there either that's suggesting, and bear in mind that gold mining stocks will tend to lead the underlying metal in both directions. I'm not seeing anything there that suggests to me that we're about to get a run in the gold market. So it's one that I think we can continue to either just maintain a very minor portfolio balancing interest, and that's probably about all. So gold actually rose on the week, but finished down, and as I said, it's stuck. Precious metals, they moved around a fair bit, but in the end they were unchanged across the week, so nothing to get excited about there. Other commodities, copper was steady at 430, nickel was a little bit lower, and what we're seeing in Australia is takeover fever is really starting to pick up. We've got Western areas now under takeover or likely takeover, and it's not going to be the finish. I think we're now moving into a part of the cycle where we're going to see a lot more mergers and takeover activity. Crude oil, these down to 70.88, not a great deal of change, and the outlook really for long-term higher prices because of underinvestment in production looks set to continue. There's the spot copper chart, so a little change there, similar with nickel. So wrapping it all up for the last edition of the year, if we look at the weight of evidence, short term, the market is quite defensive in sentiment. Now, that could all change next week and we could get a Christmas rally, who knows, but I wouldn't bet on it. This is not a market to be taking chances with because so many things have just changed. You know, what the Fed said in changing their language 2 weeks ago is a game changer. Now, whether they're right and inflation is now a problem and they need to raise rates, or whether the bond market is right and inflation is not a problem, it doesn't really matter at this point in time. The fact is the market is very uncertain and capable of moving in either direction quite quickly. So it's just a time when you need to keep your head down. Medium to longer term, the market is screaming that growth continues, because if that wasn't the case, then the bond market would be concerned about inflation and bonds would be getting sold off. And particularly given the fact that part of the reason for years and years that the bond market has been so buoyant, prices have gone up and yields have been down, is because bond traders knew that the Fed was always going to be in the market buying bonds. They were the buyer of last resort. The bond traders knew the Fed had their back and that there'd always be a buyer there. And now the Fed has said, well, we're not going to do that anymore. So why would the bond traders continue to hold bonds and with the yields going down slightly, perhaps even buy some bonds? It just doesn't make any sense at all, other than they just don't see the same outlook that the Fed is seeing. And if that is the case, then growth stocks should do really well. So despite the short-term uncertainty, I'm quite buoyed by what I've seen in the last few days for the medium to longer term. So the implication is that whilst the Fed has now said this is our position, we're going to reduce stimulus by March, we're going to have 3 interest rates in 2022, and we're going to be at 2% by 2024, that's their pathway, they may not have to follow through on that. If inflation doesn't kick up, if it subsides back down later in 2022, then the Fed will not follow that path. In America, the best risk reward is large cap growth stocks. No question about it. In Australia, it's a different market altogether. I would tend not to be in large cap growth stocks in Australia. I would tend to be in the smaller cap mega trend stocks. We've got so many stocks in the decarbonisation theme that we're spoilt for choice. So that's where the weight of evidence sits. Portfolio analyst last week did something different, did a video analysis focused on very much the skill development of members, which was very well received. And I'm going to continue that on a once a month basis. That's it for 2021. It's been an eventful year, if nothing else. I think 2022 is shaping up as probably, I expect positive overall, but I do expect volatility, possibly more than we saw in 2021. Again, I just keep preaching the same message. The clearer you can be about how you're going to operate best for you, then the better off you're going to be. So that's it for 2021. There won't be a video for the next couple of weeks for obvious reasons. I wish everybody a really happy and prosperous Christmas and New Year, and I'll be back with you in January. Cheers.